Hello, and welcome back to that One Future CPA podcast. My name is Christopher Dickerson, and today we're taking a step back to look at the bigger picture, how accounting has played a role in the decline of the middle class. Accounting may seem like simply a numbers game, but behind every balance sheet, tax policy, and financial decision, there are real world consequences. From wage stagnation to corporate tax structures, accounting has quietly influenced the economic shifts that have reshaped society, both here in the United States and globally. So, today, let's take a moment to explore how these financial mechanisms have contributed to the challenges facing the middle class. For decades, wages have remained relatively flat when adjusted for inflation, while the cost of living for just about everything, including housing, healthcare, and education, has skyrocketed. But why? I just have to say that these three things are so pertinent in my mind now as a student. One, housing is incredibly expensive for, I just got to say it, absolutely no reason. As someone who has a gastrointestinal issue and has to deal with healthcare in emergency rooms multiple times a year, I can tell you that the prices are absolutely out of this world. And if it wasn't for the fact that I was a student, I wouldn't be able to help to afford my healthcare. And lastly, as a student, I can tell you that education is absolutely one of the largest drivers of the decline of the middle class because tuition has increased in a way that I think that a lot of people cannot quantify because colleges have become so much more than just places for education. They're, in a lot of ways, regional economic drivers. So, what is one of the factors that have played a role, a hand in the decline of the middle class in relation to accounting? Well, that's corporate financial strategy. So, companies rely on accounting practices to maximize profitability, and that often includes minimizing labor costs. If you are a sophomore business student, right? That student, if you speak to that student, they could easily tell you that the number one goal of managers in a company is to increase profits for shareholders. It is not altruistic, environmental goals. It is not to provide a living wage for its workers. It's not to allow them to retire and pay for their it is to maximize profitability for shareholders. And a lot of that is done through understanding accounting principles and the way that flows into financial reporting. And as I mentioned, one of the easiest factors that managers can manipulate, right, to increase profitability are labor costs, right? You don't have a lot of control over how much your material costs. You certainly don't have a lot of control over logistics or shipping charges. You definitely have control over how many people are clocking in every single day. So, from outsourcing jobs, and again, we mentioned outsourcing on the last episode about private equity, but outsourcing jobs, increased automation, accountants are playing a role in determining how companies are allocating these resources. Additionally, financial reporting standards focus heavily on shareholder value. As I mentioned, heavily on shareholder value than worker compensation. This just reinforces a system that prioritizes profit over wages. It is no surprise that wages have been stagnant when adjusted for inflation, while costs of just about everything have skyrocketed. Right? Companies are increasing their profitability while depressing the one thing they really have control over, which is those labor costs. Now, what is another accounting driven factor? Inflation adjustments. When inflation affects the purchasing power of salaries, corporate financial statements often reflect increased costs for materials and operations, but not always proportional wage increases for employees. This means that as your costs and your materials are increasing, you're not increasing, right, profitability. You're not increasing wages to your workers. You're not putting more money into the worker's pocket. You are finding ways to cut that part of your balance sheet to compensate for rising costs and materials and operations like utilities. These decisions are driven by accounting and accountants, right? Indirectly, right? So it is no surprise that we are able to find some cause and effect relationship between the way in which accounting principles and policies guide financial corporate strategy and wage stagnation, particularly for the middle class in the United States. These two things, they just simply they go hand in hand. Next, let's speak about the way the tax policy has impacted the middle class. Tax policy is, of course, another area where accounting decisions have shaped economic disparity. Corporate tax loopholes, deductions, and credits allow large businesses to minimize their tax liabilities, often at the expense of the middle class, which doesn't have access to the same financial strategies. The one thing, and I know there are people who are listening to this podcast right now who understand what I mean, but the one thing that is so glaring about getting an accounting education is you feel like you're getting access to information that everyone should have, but for some reason, only a small amount of people can access. It is absolutely true that the system in the tax policy system that we have set up in the United States is one that is quote unquote meant to drive economic growth, right? So if your thesis is that if your thesis is that you can give more money to the people, I'm just laughing because it's like trickle down economics is so ridiculously hilarious. But if your thesis is that corporate corporations and rich people are job creators, then you should give as much tax breaks to corporations and rich people as possible so that they could take the it's just so funny. It's such a funny premise. So that they could take their money and not keep it for themselves, but give it to people who need it. It's one laughable, hilarious to think that. I mean, when corporations and rich people are making the tax laws and they're saying like, yeah, give the money to us because we're the job creators, it's like we should really laugh at that and be like, come on, like we're not that dumb. We're not that dumb. So fine. But all these tax loopholes, I mean, net operating losses, carry backs, carry forwards, you sort of take a tax class, and I'm in my second tax busy season internship. I had one last year. This year I've done a lot more trusts and so I've gotten a bit of a different understanding of the way some people's income is flowing in and out of their trusts and their companies, and it's quite interesting. But this policy, which has been in place before I was born in the 80s, this policy is an abject failure. The amount of economic disparity in the United States has only grown. And this is hand in hand with the ways in which tax policies have created deductions and loopholes and credits for those who make the most amount of money or for private corporations. In 2025, we are in the process of talking about how we are going to pass a new tax law. And I don't want to talk about politics on this podcast because this is about really business, technology, and accounting. But what I do want to talk about is the realities, right? So there are pretty large tax cuts on the books right now from 2017 that those in power may want to extend. That will absolutely 100% come at the cost of the middle class, right? The middle class will 100% bear the cost of any tax cuts that are coming down the pike. Why? Because that's the place you have left to cut. One of the suggestions is to begin to tax the scholarship money that students receive. Now, as it that is catastrophic, right? A lot of students who are from the lower middle class or from the lower class, work incredibly hard to get to college and take pride. I remember every single year at school when I was in high school, because we were a pretty big. I went to an engineering magnet high school in El Paso, Texas, Chapin High School. Go Huskies! I love my my principal, Dr. G. She really instilled excellence in us at a young age, and I remember them listing how much scholarship money had been received by students of that graduating class. How many students got into places like West Point on scholarships? I remember that was a big thing for us in high school. Also, a level of pride to be like, yeah, but so these students who I went to school with, who grew up in the neighborhoods I grew up in, if they were taxed on the scholarship money they received, it would be devastating. They would have no way of getting that money except for working while they were in school, which most likely would lead to them having a lesser of a chance of graduating, right? This is literally just one example, and perhaps we'll do when we have some harder proposals on the table, perhaps we'll do a podcast about how some of these proposed tax changes will impact the middle class. But these are just some examples. Let's talk about some others. Depreciation rules and tax incentives allow corporations to defer or reduce taxes while wage earners pay income taxes immediately. Depreciation, double declining, accelerated, it's these are ways in which companies have a legislated advantage over normal Americans who earn their money on W-2s, which is of course, the majority of Americans, right? This shift from progressive taxation in earlier decades to a more corporate friendly tax code has meant that middle class households are bearing a larger share of the tax burden. I'll use this example. In El Paso, I remember growing up and always reading the news, which I love, reading the news and hearing about how much of the residential portion of the city paid taxes, right? Because there weren't a lot of businesses or not a good share of businesses or large businesses to take a lot of the tax burden off. So it was being pushed on to residential homeowners. This is the same thing here. So the government is not just going to forego the money that they give away in bonus depreciation to private companies. They are going to increase that burden on to middle class households. I don't actually have time to speak about the ways in which the tax code in 2017 took away so many deductions and credits. We could talk about SALT. We could talk about so many things that impacted the middle class that are on the table now for this new tax law, right? Accountants and tax professionals, again, are playing massive roles in structuring these tax strategies. It's their job. It's not a blame game here. It is the reality that accounting is undergirding some of these policies, especially when it comes to federal tax policy. Next, I want to speak about financialization and the rise of shareholder primacy. Over the past few decades, we have seen a shift towards financialization, which is where financial markets, institutions, and accounting practices are dictating corporate decision making more than the actual production output or labor. Now, one key accounting concept here is shareholder primacy. The idea that companies exist primarily to increase shareholder value, as I mentioned earlier in the episode. It does actually not take a CPA license to understand this because it's one of the basic principles of business. So, in an intro to business or an intro to financial managerial accounting class, you learn pretty upfront that the company exists for the shareholder to increase value for the shareholder and should do everything in a way that puts the shareholder first. Now, this principle is reinforced by financial reporting standards and GAAP, generally accepted accounting principles, and has led to cost cutting strategies like stock buybacks instead of investing in its workers. Now, we spoke about how those tax loopholes, those depreciation loopholes, those incentives and credits are supposed to go back into the corporations, back into the rich people who own them and work at them, and supposed to then flow down into workers, right? But we know that is not the case, right? We saw after the financial crisis of 2008 that companies were taking money and not investing in workers. They were slashing jobs, but they were buying back. There could be a series on accounting malfeasance during and after the pandemic of private corporations, but plenty corporations piled their profits into share buybacks rather into reinvesting in workers. And that's one of the reasons now, while we're still struggling with the worker supply chain, because those investments were not made with that capital that was available during the pandemic. And now that the capital is drying up because interest rates have increased, we're again seeing these corporations tightening their belts by doing what? Cutting jobs, right? So because the shareholder primacy idea exists and is functionally embedded into our financial reporting system, a manager at a company is behooved, rewarded, in fact, required to think about what is best for the company before he or she thinks about what is best for their team. This is interesting. Stock buybacks were once illegal because they were considered market manipulation. They are market manipulation. I mean, they're considered market manipulation because stock buybacks are market manipulation. But changes in accounting regulation allow them to become a common practice. Policy is what's driving these changes. Companies are not saying, "Hey, I'm going to start buying stock back." They're saying, "Well, if it's available, if the financial strategy makes sense, then yeah, we're going to institute stock buybacks." And again, if the stockholder is the most important person in the business, then stock buybacks make a ton of sense. So, for a company with rising profits, the calculus is that instead of raising wages, instead of expanding operations, many companies now use their excess cash to repurchase their own shares, which manipulates the market by boosting the stock price. Okay? And who is invested in the stock price? One of the craziest things I ever experienced was I did a co op at a pharmaceutical company and I got stock options, and the amount of stock options I received and how much they matured in 1 year was astronomical to me. It was actually kind of crazy. And I thought to myself, if I'm just a intern, co-op, trainee, and I'm getting this financial benefit from the stock options, imagine the people in management. So again, if a private company gives restricted stock options to its managers, the manager then must think, I have to do what is in the best interest of the shareholder, which so happens to be me, rather than what's in the best interest of my own workers. Stock buybacks, when they manipulate the stock price, that increase in profit and money and capital goes right back to the managers. It is a circle of, I can't even say it. It's what it is playing in our face, and it has again, a complete cause and effect relationship to middle class wage stagnation. These are not things that are secrets, right? Companies announce stock buybacks on CNBC. Like, this is stuff that people know about. But I don't think they understand what a stock buyback actually means for them and for the company. Increased financial education is the way, one, out of the middle class, and two, out of these restrictive policies that we've been dealing with for far too long. So after all of this, after all of that discussion and pointing out what are the issues here, what is the path forward? Can accounting be used to reverse some of the trends that it helped precipitate? I think that some of the potential solutions that we see in this space here begin with reforming financial reporting standards. A reformation of these standards could help us redirect our attention to broader economic impacts rather than just shareholder returns. This would mean a departure from the shareholder primacy idea and principle, but would help us better understand how a company impacts the broader economy rather than how much value it returns to its shareholder. Next, although there is little hope in this solution, is shifting tax incentives to reward companies that invest in workers rather than just executive compensation. I'm not going to sit here on this podcast and lie and say that I think there is a strong chance for worker centered tax reform. I absolutely do not believe that is the case. What I believe is that those in power who will be writing our upcoming tax law believe in their mind that trickle down economics works and that you have to slash tax uh, tax liabilities for companies and those who make more money so that that money can trickle down into the economy. So no, I don't see there will be any way to reward companies that are putting workers first. In fact, a lot of policies that again are being floated out there, like no tax on tips and things like that. There's a lot. There are a lot of ways in which corporations have very sophisticated tax attorneys and accountants who will manipulate that for their executives. In fact, even now, most executives make less than $1 million in salary because that's how you manipulate your way around the tax code about highly compensated individuals. And it's like everyone knows that because every major CEO of a bank or a publicly traded company is making like a million or $1.1 million, $1.5 million, but then making $30 million in stock options and deferred compensation. And so it's like it's a laughable game that we're playing here. Again, the last solution that we came up with is one that we don't have a lot of hope in, and that's advanced, environmental, social, and governance or ESG reporting to hold corporations accountable for labor practices. Now, just because I think that something does doesn't have a chance of happening in the short term doesn't mean that I don't think it's a pertinent or an important solution to speak about. I do believe that ESG reporting has a place in the future of corporate reporting in the United States, just like I believe that tax policy and the reformation of the way that we tax rich individuals and private corporations is possible. I just do not believe that it's possible in the short term. And I mean that in the next 10 years because this tax policy that will pass will be in effect for quite some time. However, accountants, policymakers, accounting leaders should find ways in which they can work in the community to help power some of these shifts. How can we empower small business owners to understand the best way to use the tax code? How can we empower W 2 earners and students to understand the ways to best use the tax code to their advantage? How can we provide community education in a way that rich people and corporations are not the only ones that are taking advantage of tax policy? Everyone should have the opportunity to take advantage of the government in a way that is legal because you are applying the tax code. So I think that myself, I actually can't wait to get to graduate with my master's and get up to Chicago and really get into the community and really find ways in which to use the knowledge I've gained to give to others. I'm like, you need to know this. You need to know, even if you think you'll never own a business or even if you think you'll never have $1 million, you need to understand investments. You need to understand 401ks. I got all my family into 401ks because I was like, you, this is how people are becoming millionaires on paper is by literally just putting money consistently into a 401k, taking advantage of the company match, putting that into the market, which is the United States stock market is a consistent and reliable performer. This is how people are becoming millionaires on paper. A lot of people don't understand that. They don't even understand what 401k means, a company match. So I can't wait to get into the community once I graduate to help provide some of this education. I think that the last point I want to make is accounting has contributed to the economic struggles of the middle class. Accountants have contributed to the struggles of the middle class, but it also has the power to drive positive change if we use it responsibly. And that does it for this episode of That One Future CPA podcast, episode 5. Now you'll notice that I'm wearing the same clothes as episode 4. We actually recorded 2 episodes on a Sunday on campus because what else to do on a Sunday besides this and homework? So, don't judge me for wearing the same thing 2 weeks in a row because I didn't. It's the same day. Now, next week we want to talk about women in accounting. This is something that I wanted to tackle last year. Then, some things happened in DC. And then there's been some changes around how companies are approaching what they consider to be DEI. And so I wanted to talk about an aspect of this conversation that's not really talked about a lot. And that's also about, women barriers. I think that they make up a significant portion of accounting workforce, but still a depressed amount of leadership and partners. They still lack some pay equity, and there's still some workplace culture questions to be had. Now, before you listen to this episode, or I guess you're listening at the end, so listen to the other ones, listen to all of them, like them all, subscribe to the podcast on both Spotify and Apple Podcasts so that you can get notifications when the podcasts are available. Please make sure that you leave a comment and stick around because we have some other conversations about tariffs coming up on some other episodes. So definitely some conversations that are applicable to the wonderful, interesting life we're all living today. So thank you again for tuning in to That One Future CPA podcast, and we'll see you next time.